If you're a senior homeowner in Australia, there is a date circled in red on Centrelink's calendar that almost nobody is talking about, and it could change your fortnightly pension before the year is out. Around the 20th of August, the government is legally required to lock in the next set of numbers that decide how much of your savings, your super, and your investments actually count against you. Miss this, and you could be blindsided by a payment drop you never saw coming, or worse, you could be sitting on a part pension entitlement you didn't even know you qualified for. Stick with me for the next few minutes, because I'm going to walk you through exactly what is confirmed, what is still just rumor, and what you need to check in your own situation before September rolls around. Welcome back to Aussie Benefit, the channel where we cut through the confusing headlines and government jargon to give you straight answers about pensions, Centrelink, and retirement in Australia. If this is your first time here, consider hitting that subscribe button, because we publish new breakdowns every week on exactly the kind of changes that affect your hip pocket. Today we're tackling one of the most searched and most misunderstood topics for older Australians right now, the so-called August 2026 pension shakeup. There is a lot of clickbait floating around claiming your family home is about to be added to the assets test, or that your pension is about to be slashed overnight. Some of that is exaggerated, some of it is flat out wrong, and some of it is genuinely worth your attention. So let's separate fact from fear, one piece at a time. Let's start with the single biggest myth doing the rounds. Your family home is not, and as things currently stand will not be, counted as an assessable asset under the age pension rules. That protection has been in place for decades and it remains in place right now. So if you've seen a video or an article claiming Centrelink is about to start taxing you on the value of the house you live in, that is not an accurate reflection of the current rules. What is genuinely changing, and this is the part that matters, is everything around the home. Twice a year, in March and September, the government reviews and updates the income and asset thresholds that determine how much pension you receive, and by law, the Minister for Social Services has to announce the new deeming rates at least 1 month before they take effect. That means by around the 20th of August, we will find out exactly what the September 20th changes look like. This is where the real action is, not in some dramatic new property law, but in these quieter, technical adjustments that quietly move the goalposts for millions of retirees. Here's why deeming rates matter so much to homeowners with savings or investments. Centrelink doesn't look at what your term deposit or your account-based pension actually earns you. Instead, it assumes, or deems, that your financial assets are earning a set rate of return, and that assumed income is what gets counted in the income test. Right now, the lower deeming rate sits at 1.25% on the first tens of thousands of dollars in financial assets, with everything above that deemed at 3.25%. These rates were increased earlier this year after being frozen for a long stretch during and after the pandemic, and many retirees felt that bite in their fortnightly payment even though their actual bank interest didn't change at all. The big question hanging over August is whether the government pushes these rates higher again in line with the cash rate, holds them steady, or offers some relief. Seniors advocacy groups have been pushing hard for a slow, measured approach, arguing that older Australians on fixed incomes shouldn't be punished by numbers that exist only on paper. Whatever gets announced will directly affect anyone with savings, shares, managed funds, or superannuation balances sitting above the threshold. Now let's talk about the asset test thresholds themselves, because these also get indexed and adjusted throughout the year, and they determine how much you can hold before your pension starts tapering off or cutting out altogether. As it stands, a single homeowner can hold assessable assets up into the low 300,000s and still receive the full pension, with the part pension cutoff extending out considerably further, into the mid to high six figures. Couples who own their home have correspondingly higher combined limits. Non-homeowners get higher thresholds again, because they don't have that home exemption working in their favor, so if you're renting or don't own outright, your numbers look different. The key point for every homeowner watching this is that your house itself stays outside these calculations. It's everything else, the car, the shares, the caravan, the superannuation, the term deposits, that gets added up and measured against the line. There's one more piece of the puzzle that's causing genuine confusion, and it involves aged care rather than the pension directly. Reforms to the aged care system that came into effect back in November of last year changed how home value is treated when it comes to working out fees and contributions for residential aged care, not for the age pension itself. These are two completely separate systems, but a lot of headlines have blurred them together, making it sound like your pension eligibility and your future aged care costs are the same calculation. They're not. If you or a family member are looking ahead at potential aged care needs, that's a conversation worth having separately. That's the real story behind the August 2026 pension changes for senior homeowners, separated from the noise and the clickbait that's been circulating. The short version is this: your home stays protected, but the numbers around it are shifting, and staying informed is the only real defense you have. If this video helped clear things up for you, do me a favor and smash that like button. It genuinely helps this channel reach more retirees who need this exact information. And if you haven't already, hit subscribe and turn on notifications, because Aussie Benefit will be back the moment the official August announcement drops with a full breakdown of exactly what it means for your fortnightly payment. Drop a comment below and let me know what state you're in and what questions you still have. I read every single one and it helps me plan the next video. Thanks so much for watching, take care of yourselves, and I'll see you in the next one.